Oh, hello. I didn't see you there. I'm Scott Fox, lifelong insurance nerd. And today we're talking about 4 car insurance myths that sound harmless but can quietly cost you thousands of dollars. Most people don't read their auto policy. They rely on phrases they've heard like full coverage or state minimums required by law, or insurance has nothing to do with your credit. And the problem is, insurance language and marketing language are not the same. So in this video, I'm going to break down 4 dangerous car insurance myths, what's actually true, and what you can do about it so you don't learn the hard way after a crash. Let's get nerdy. Most drivers think they're fully covered until the accident. But here's the plot twist. Full coverage doesn't actually exist. Today, I'm breaking down 4 car insurance myths that are quietly costing people thousands of dollars and how to fix them before it's too late. And just so you know where I'm coming from, I'm the kind of person who actually reads the insurance policies they sell. You'd be surprised how many insurance agents don't. I see these mistakes every single week. Let's get nerdy. Auto insurance is one of those things people only care about for 2 days: the day they buy the policy and the day they have an accident. In between, most people never look at it again. And I get it. Insurance policies are boring. The language is confusing, and the quotes are all over the place. So people latch onto simple phrases they've heard. I just want full coverage. Give me the minimum limits required by law. My car is red, so it costs more. My credit shouldn't matter. And the problem is, those myths create coverage gaps that don't show up until you're already in a claim. And that's the worst time to discover you're missing something important. So let's start with the most expensive myth of all. You've heard this one. You've probably said this one. I'm good. I've got full coverage. What people think it means. They think it means everything is covered. I'm safe. I won't get surprised. In the real world, full coverage usually just means you have liability, comprehensive, and collision, which is better than liability only for sure. But here's what it does not automatically include, even though people assume it does: rental reimbursement, gap insurance, uninsured motorist property damage, higher liability limits, medical payments, glass coverage. And those are not small details. Those are write a check details, real world risk. Let's talk about liability for a second, because this is where people get hurt financially. In California, you can legally carry very low limits of liability, and a serious injury accident can blow past your $30,000 in minutes. An ambulance ride, an ER visit, imaging, physical therapy, lost wages. That's before we even get into the possibility of a lawsuit. It is painfully true. I've seen people with full coverage still owe money out of pocket because full coverage probably doesn't mean what you think it means. Nerd tip: stop saying full coverage. Ask 2 specific questions instead. What are my liability limits? And what coverages do I not have that I should consider? Because that's where the expensive surprises live. Now let's hit the next myth. And this one is quick, but people swear it's true. People have actually told me a red car equals higher premiums. And honestly, I understand why, I guess. It sounds like something insurance companies would do. But it's not. The reality is carriers don't care based on color. What they rate on is stuff like your VIN, the trim, the engine, the safety features, repair costs, and parts availability. horsepower and performance class, theft rates for that particular model, claims history for that particular model, your driving record, your location. So if you think your red car costs more, what's really happening is usually one of these. The model is expensive to repair. The model gets stolen more. The vehicle is classified as higher risk, or the driver and the location factors are driving the rate up. Nerd tip: if you want a cheaper car to insure, don't shop by color. Shop by safety ratings, repairability, theft rates, and whether it's a high-performance trim. Your broker should be willing to give you a quote on different models before you buy, so you have an idea of how it will affect your premium. If they're not, maybe time to look for a different broker. Myth number 3 is where people get mad at me. We're going to do it anyway. People think insurance has nothing to do with my credit. And morally, I understand why people feel that way. The reality in most states, however, is insurers use what's often called an insurance score or similar predictive model as part of rating. Now, very important to note, rules vary a lot by state. California specifically, there are restrictions and regulations that change what can and can't be used in pricing. So don't take this as everywhere always the same. But here's the practical point. Where allowed, credit-related scoring can be one of the biggest silent pricing factors. Key clarifier, it's not your FICO score for lending. It's a predictive insurance scoring model that tries to estimate risk based on patterns. And yes, that means two drivers who look identical on paper can get very different prices. And your credit comes into play there. Same car, same zip code, same driving record, different premium. Why this can cost you thousands is because if you're shopping insurance and you think, I'm being quoted high because the insurance company is greedy, you might miss the real reason you're being priced that way. And then you might do the wrong thing. Lower your coverages too far, raise your deductibles too high, or choose a carrier that looks cheap now but isn't stable at renewal. Nerd tip: if your premium jumps and nothing's changed, don't just accept it. Ask what rating factors drove the change. Because if it's something fixable over time, you want to know early. Now for myth number 4, and this one is the one that can ruin you financially. The minimum limits allowed by law must be enough. It's a very normal assumption. The reality is that minimum limits are political numbers. They are not financial protection plans. A common example people recognize is 1530 for bodily injury. That's $15,000 per person, $30,000 for occurrence. In the state of California, it's $30,000 and $60,000, but it does vary by state. Here's the uncomfortable truth. Modern hospital bills can exceed that instantly. One injury claim can blow through that, and if you're at fault, the rest doesn't just magically disappear because you have low limits. This is where real-life consequences show up, like asset exposure, lawsuits, and the part that people don't really think about, wage garnishment. That's right, even if you don't have a pile of assets to protect, if there's an accident and it's your fault, they can go after your paycheck. And here's the line I want you to remember. Minimum limits protect your license and registration, not your net worth. If you have savings, home equity, a decent paycheck, or a future you'd like to keep, you want to think beyond the legal limits of liability. Nerd tip: match your liability limits to the life you're protecting, not the minimum the DMV will accept. And if you want an extra layer of protection, an umbrella policy can sometimes be surprisingly affordable, depending on the situation. Quick recap. Full coverage just isn't a real thing. Your car color doesn't matter, but your credit often does, depending on your state. And minimum limits can be dangerously low. If you want me to review your current auto limits and quickly spot the gaps, check the link below. I'll tell you what you have, what you don't, and what I consider changing based on your situation. Thanks for watching, and as always, stay nerdy, my friends.